Hello everyone, welcome to the Ichimoku daily analysis for gold for Friday, February the 5th, 2010. Well, a very small body candle today, and this is a doji type candle, and this type of candle is a warning of indecision. The doji candle means that there's a very small body or no body to this candle, and that means that neither the bulls nor the bears made any net progress on the day. So that's not good for a market to do that. The previous day we had a very large amount of net progress by the bears. Today all of that's dried up, so that doesn't really paint a nice picture for the continuation of this trend in the first time frame, which obviously is to the downside. So today's candle continued that trend with a lower high and a lower low. If we look at the range of the candle, between the distance between the high and the low compared to the distance between the high and the low previously, that range has contracted rather severely. And that tells us that the sellers are not as eager now as they were previously. So that raises some doubt about the continuation of the downtrend. Also, we have the market closing roughly at the same level as the previous close, and that tells us that neither the bulls nor the bears showed any keenness. Now, because the market did trade down below the low of the previous candle, we have this long shadow on the bottom. That means that we had upside price rejection as the sellers tried to take control of this market, and they did at one point when they traded down towards the low. The buyers came back in, and the sellers lost the commitment that they had. So a very strong loss of commitment. Yesterday the sellers were very strongly committed, and today they've lost all of that commitment. So that sets this market up for a potential reversal. Now, this also is not quite a perfect hammer pattern, because we don't like to see a shadow on top of the hammers. The S&P had a small shadow. This is a slightly larger shadow on the top of the body, and it's a little bit iffy whether it strictly is a hammer type pattern, but the ramifications for the market are still the same. It's the loss of commitment, the upside price rejection, and potential for a change of trend. Now, the market is reacting to this zone of resistance around this 1066 to 1080 area, and interestingly though, the bulls weren't strong enough to close the market up within that area, and certainly they did trade up there for a period of time, but there was downside price rejection from there as well. So that area becomes very important for this market. If this market is going to rally and potentially rally up towards the cloud or the Kumo, then we would like to see a solid bullish close up above the 1080 level. Overall, though, the market is still negative. It is trading down below the cloud and trading a fair distance below the Tenkan-sen and Kijun-sen, and that Tenkan-sen and Kijun-sen are pointing down fairly sharply, reflecting the strong downside momentum, and they're two areas where there could be resistance if the market does trade up above that zone that we mentioned previously. So the Tenkan-sen is at 1085, the Kijun-sen is at 1103. So overall, the market is still negative, but we may have a brief pause in that negativity, potential for a rally, and then watch to see how the market reacts if it does rally, and look for another potential sell-off for the market to test the 1,029 and perhaps even the $1,000 level.